Hello again, I'm Aaron Turner, and this is another edition of MCC Street Talk. Today we are privileged to have a great panel with us, and we hope for them to be able to enlighten us on some recent domestic and even international topics that have made headlines. Our first analyst, Joshua Donner, is with us, co-founder and vice president of the Applied Business Concepts Club here at MCC. Josh, welcome, and thank you for being with us.
Thank you for having us.
Recently, we've heard about the Fed looking to raise interest rates. Josh, could you tell us what we could see happen with the looming idea of rates rising?
Well, before we get into the effects of a rise in the interest rates, I think we should look at what the Fed, or the Federal Open Market Committee, actually does. There's three basic functions to the Fed. One is to keep unemployment low, two is to keep inflation low, and three is to have stable economic growth. To illustrate how these functions work together, I'm going to use the example of a company considering a new capital project. When a company considers a new capital project, one of the key decisions they have is their cost of capital, or the cost that they're going to incur to borrow money to start a new project. During the economic recession of 2007, the returns on new capital projects was really low. Therefore, the cost to borrow money to start a new project needed to be low to make more projects attractive. When new projects are funded, that means more jobs. Right now, we have an unemployment rate of 5.4%, which is close to being full employment, which is 5%. And with the strengthening of the dollar, we see that inflation isn't taking hold yet. So an increase in the interest rates is going to allow the Fed to be able to lower the interest rates in case we do see some economic downturn.
I see. So it seems like part of the reason we could see a raise in rates is actually the stronger greenback. Someone that hopefully can enlighten us on that is Nicole Mooney, another current student here at MCC. Nicole is transferring to UConn in the fall, and she's also the secretary of the ABC Club here. Nicole, pleasure to have you with us.
Happy to be here.
Nicole, tell us, how could you see foreign buyers being affected by a stronger greenback?
Well, first I want to talk about what a strong dollar means. It means that it has a higher exchange rate than a compared currency. So for example, as of today, the exchange rate for a euro is 1.13 euros for every dollar, which means you could go and buy more for your money in any country that's in the Eurozone. So say you had like $100, you would get more out of your money in any country over there compared to in the US. Foreign buyers could be affected in three ways. First, foreign buyers would be affected by the rise in cost of US goods. Since it would cost more money to buy US goods, it could lead to a decline in foreign demand. Secondly, with a decline in foreign demand, this could lead to a decline in US exports, since it could be less attractive to foreign buyers to buy US goods.
Well, with exports accounting for 14% of GDP, I mean, that could really reduce major American corporate profits and earnings, no?
I completely agree. With a decrease in exports, this could lead to a decrease in production. And with that, with both a decrease in exports and production, this could lead to a decline in corporate profitability. And with the demand of the US goods decreasing, this could lead to a decline in operating income. And when the operating income decreases, this could lead to multiple things like less cash coming in and a decrease in retained earnings. With less cash coming in, this could cause the balance sheets to weaken. And when that happens, corporations have less cash and they need to borrow. And when they can't borrow as easily, especially with the interest rates going up, as Josh was talking about, they need to find ways to cut costs. And when they need to cut costs, one of the easiest things to do would be to cut labor, which could definitely affect many people domestically.
Well, this sounds like a negative side of it, but Austin Kopp is with us today, another current student here at MCC, as well as an avid member of the ABC Club. Austin is as well transferring to the University of Connecticut. Austin, thanks for being with us.
Pleasure's all mine.
Austin, tell us the opposite side. Tell us how you think the dollar and overall aggregate growth could be affected.
Oh, well, thank you. So as you said, Nicole had more of the negative side of the stronger dollar. But the stronger dollar can actually help the U.S. economy in ways, I think, kind of offset the negative side. So the strength of the U.S. dollar basically shows that the U.S. dollar and the U.S. economy is growing. And not just that it's growing, it's actually growing faster than relative economies like the Eurozone, China, and Japan, which are all growing, but just not at the same rate that the US economy is growing. So it shows a lot of US growth. And basically, a way to think about it is if you have $100,000 and you decided to take a trip over to Europe, because it's so lovely over there. So you go to Europe, with that $100,000, you could buy more in Europe than you could in America because the dollar is stronger. So that can help out in 3 different ways. The first way is with imports, which is a major part of any business. If you are trading overseas, say you're getting raw materials from Europe or from China or from Japan, that can cut a lot of your expenses so that it costs less to make all of your products, which can really benefit the corporations. And the American economy has actually been growing and has been growing very steadily since 2011. It's now up about 15% of where it was back then. And with this, you can see with the American economy growing, you can see companies are doing better. People's faith in companies are kind of getting more restored. People are investing in companies, and when people invest in companies, it gives companies the capital to expand. They can start new projects. New projects could mean new job positions open. New job positions open mean that more people are being paid and have salaries. With more salaries and people being paid, you can see them be able to buy more from other companies, and other companies expand, and it just kind of raises the US economy up from the inside. And with imports being less expensive, it means that companies can cut costs there by getting all of their raw materials from outside of the US, and it really helps domestic companies be able to kind of bulk up in the United States. And that leads to kind of the third point. Foreign companies and foreign investors might look to the United States and say, wow, they're doing really well. We should invest over there because they're growing at such a faster rate than we are over here. So you can see more foreign investors coming into America and investing in our stocks and bonds and just helping raise the US economy even more.
I think that's a really important thing to note, because we keep talking about the influence of a stronger dollar and how GDP and production and even aggregate demand for U.S. exports are being affected. But what does this really mean to investors looking at U.S. financial markets? I'll open this question to anybody that wants to start.
Well, Nicole alluded to this earlier when she brought up the softening of companies' balance sheets. Our big multinational U.S. companies are being hurt by a stronger dollar because they're not generating as much revenue from outside the United States. Many of the Dow companies, which are the largest 30 in the U.S. economy, generate almost 50% of their sales and revenue from outside the United States.
Wow.
So that makes a big difference when we have a stronger dollar.
I also think that when it comes to a stronger dollar, foreign investors are more likely to invest in us since they see how well we are growing and it is a safer place to invest. So I do see where you're coming from, but there are also the benefits and the downfalls of it.
And with the financial markets, with higher interest rates, which you were talking about earlier, if the Fed wants to raise the interest rate, we could see U.S. government bonds go down. And U.S. government bonds right now are pretty much the most stable, reliable thing in the market right now for bonds. So if they raise the interest rate, we might see less people going there. It might go to stocks, or we might have a loss for U.S. income in that sense.
But I think we can all agree that with the recent Fed meeting that's actually taking place today, that everybody's waiting for what the Fed's going to do next. I mean, I want to ask the next question in the sense that what can we expect to be able to take away, or what can the average person be able to take away from this Federal Reserve address today taking place?
I really don't think the American public should take too much away from the Federal Reserve's statements that they're going to make after their meeting. I think it's more important to be aware that it's happening and to get a sense of how the Fed feels the economy is doing. I think the Fed needs a little more ambiguity to be able to use their monetary policies more effectively and to create less volatility every time they make a statement.
I agree with that. I would say the average person does need to be aware of what they're saying, but they also need to make sure they don't take it to heart. But they just need to be aware of what they're doing with their money.
Whenever the Fed makes a statement, people always, sometimes they'll overreact. They'll go, "Oh no, what's going to happen? It's going to go up and down. Everything's going to tank." But people need to remember, stay calm, think in long term, start saving now, and not worry about all of the minor ups and downs, and like I said, focus on the long term.
Long term, right? Well, before we wrap it up here, I'd like to take some time now for our panel to be able to express a final thought that they'd like to leave our audience with, something that would resonate with them. Nicole?
I would say be more informed about the economy domestically and internationally, and be smart with your money and save.
I'd say if you can quote stats from sports, you should be able to quote stats from the economy, which is going to have a much more profound impact on your life. You should probably start saving early.
Learn all you can as soon as you can, and buy low, sell high.
Nice. To quote a recent article in the Wall Street Journal, by their nature, the policies the Fed and other central banks have used to prop up growth foment risk-taking. Low interest rates make their income generated by stocks, corporate bonds, real estate, and other assets more attractive by driving up their overall value. I think that's an important thing to appreciate with said actions forecasted or those that are implemented already. As a final note for myself, I'd like to thank our panel for being here today and the preparation they put into making this all possible. And I would personally like to thank Manchester Community College for making this possible, as well as the time that I've spent here as a student. There's no close alternative to attending MCC, and I am forever grateful for the faculty and friends that I have met here. Looking towards the future, I hope and encourage future and current students to get informed and pay attention to what is going on around them. These things are very important. Lastly, apply these concepts to your day-to-day lives, and if need be, seek help from the avenues available to you. Until next time, I'm Aaron Turner. This has been another edition of MCC Street Talk. Stay classy, MCC.